A building can be 95% financed, look incredible on paper, and still underperform within the first 6 months. Not because the deal was bad, but because of something most investors don't fully understand until they experience it: lease-up risk. In this video, I want to walk you through how lease-up actually affects returns, and more importantly, why the numbers you see in a pro forma often don't match what happens in the first year of ownership. If you're new here, I'm Darren from DK Wealth and Growth, and if you've been following along, you know we focus on disciplined CMHC-eligible multifamily investing, especially in markets like Edmonton. This is one of those topics that doesn't get talked about enough, but has a very real impact on how your deal performs early on. Let's start with rent. Most pro formas show projected rent, what the units are expected to lease for once everything is stabilized. But in the real world, early leases don't always happen at those numbers. Sometimes you need incentives, sometimes you need to test pricing, sometimes you simply need time to find the right tenant mix. So what actually matters isn't projected rent, it's effective rent, what you're truly collecting after adjustments. Here's the impact. If you're off by even $100 to $150 per unit across a building, that can translate into tens of thousands of dollars in reduced income over the first year. And that's before we even factor in vacancy. That's where investors start to feel the difference between paper performance and real performance. Next is lease velocity, how quickly units actually get filled. On paper, stabilization often looks smooth. In reality, leasing takes time. You might fill a few units quickly, then slow down, then adjust pricing, then fill again. It's rarely linear. And during that time, something important is happening. You're still carrying operating costs, debt payments, utilities, maintenance, but without full income coming in yet. That's where early pressure builds. Then you have concessions, free rent, discounted first months, incentives to attract tenants. These are rarely highlighted in pro formas, but they directly reduce your effective income during lease-up. And when multiple units require concessions at the same time, the impact compounds quickly. Now connect everything: lower effective rent, slower lease-up, concessions. That reduces net operating income. And when NOI drops, your DSCR tightens. So a deal that looked very comfortable on paper can suddenly feel much tighter in practice. Not broken, but definitely different than expected. This is especially relevant right now. Edmonton vacancy has already increased slightly and more supply is still being absorbed. That doesn't mean the opportunity is gone. It just means assumptions need to be more realistic. The takeaway is this: lease-up doesn't usually break a deal overnight, but it quietly reshapes your return profile in the first year. And disciplined investors don't ignore that. They build it into their expectations from the start. If this kind of disciplined approach to multifamily investing resonates with you, make sure you subscribe to the channel. Each week, I break down how serious investors evaluate CMHC-eligible opportunities and what actually happens once those deals move from paper into reality. And next week, I'm going to take this one step further and walk through something most investors completely underestimate: the stabilization timeline and how the first 12 months of a project can quietly rewrite your returns if you don't model it properly. If you want to review opportunities where these assumptions are already stress tested, you'll find links below where you can join the investor list or explore current deals. Thanks for watching, and I'll see you in the next video.